the first step where we really worked hard with Morgan Stanley in crafting the equity story and thinking ahead sort of how we're going to take this forward. Then 2019 rolls around and we said we were going to, like, our ambition was to then sort of aim for an IPO in 2020. And so in 2019, we did a non-deal roadshow with Morgan Stanley. And that was helpful in the sense that we had met people in 2018 who couldn't invest at the time, but who had started to follow the company. In 2019, we didn't have anything to sell. So it was really just like, hey, let us give you an update. Here's what we told you last year, what we're going to do. Here's how we did. And so we started building credibility as a management team around execution, helping people understand the story even better, getting to meet additional public investors. This was sort of then with the idea of eventually we're going to come to market. So you want to start following us and you want to start understanding the story. And then in early 2020, I still remember this, we had a discussion with the board and they were like, okay, there's an open window. You got to go now. And I had spent a little bit of my personal capital trying to convince people the company might need another 6 months or so. But the board decision was, no, we're going to go now. And a week later, the world shut down.
Hi, Hanno. I'm super excited to have you today at Finance Unscripted. We've been discussing about this for some time, and finally it's happening. Yeah, fantastic career, just going through different companies and eventually leading finance function of one of the most exciting companies out of Europe, public company as well. So many things to unpack today. I wanted to start with a question that like if you think about younger yourself when you're growing up in Germany or maybe or in university, uh, basically, what's one thing that you wouldn't believe about your career today?
Yeah, I don't think I would have thought that I ended up where I ended up. That was certainly not sort of on the horizon of leading a public company as a CFO at some point. It's been a really fun journey. And to be honest, a lot of that was sort of right time, right place. And um, it wasn't certainly sort of a mapped out path. Sometimes you had to sort of roll with the punches and take an opportunity, take some risk, and obviously it worked out. But I wouldn't have thought 20 years ago that I would be sitting here today.
So yeah, your career was progressing from small town in Germany and then great universities, public company, Wall Street, great investors. So when you think about your career, so what's the most expensive mistake you made earlier that shapes how you lead today? What are the things actually just contributed to your leadership style?
I like to I'd like to think I learn from other people's mistakes. And I think I've seen uh, people make mistakes and sort of think, oh, I don't want to do this and I want to be different. I think one of the pieces of feedback at some point early in my career I got, especially as I was living and working in the US, but I grew up in Germany and Germans tend to be very direct. And so I got that feedback about my communication style of being very abrupt, very direct. And especially when you're in board meeting settings as a board member or representative of a private equity firm and then talking to the portfolio companies, anything you say has a different weight, even though you yourself may think of yourself as just sort of a junior board member, but the portfolio company sees you as the representative of the private equity firm, and so I wasn't really cognizant of the impact that and the style of communication I had, and so I worked on that a lot. And then I've seen new execs coming into companies with a sort of an attitude of, I know everything better and everything you've done here is not great. Um, and I felt that was very toxic. And when I joined Trustpilot in particular, I was very cognizant around sort of being sort of taking my time to learn the business, assume that I don't know why things are being done, even though if my first judgment might have been this doesn't make a lot of sense, and ultimately I was right. I didn't sort of jump to that conclusion immediately, but took the time to understand why we were doing certain things. And I mean, in hindsight, I could have probably been a little bit more assertive early on, but at the end of the day, it all worked out.
Yeah. One other topic I wanted to discuss is a transition from being an investor to operator. It's quite big mindset shift, where so you moving from allocator to builder, and a lot of investors actually struggling in that transition. Curious, what are the things you learned being an investor that really sort of help you to be CFO of public company?
I think that I had a maybe somewhat easier transition in the sense that I went from Apex to Bankrate, but at Bankrate, my role initially was very much focused on M&A and buying companies. So it was sort of like similar to what we were doing at Apex, just in a smaller scale, and then thinking about synergies. We really buy and build strategy where we expanded Bankrate quite significantly through transformative M&A. And so, especially early on in the first couple of years, we worked on two large transformative acquisitions where I worked a lot with advisors. And um, so the process was similar, very similar to private equity in that sense. And what really helped me was coming from Apex, going onto the Bankrate side, and then working closely with the CFO. I was able to help him shape his board presentation. I know that very early on we were doing a budget, and it was sort of at the tail end of the financial crisis. We had to do a cost saving program and sort of a budget for the next year, and I was able to help him to craft the narrative for the board, provide the slides in a way that I knew that that would resonate with the investors because he went obviously from public to private, and the board discussions were very different, much more data driven, much more analytical, rather than sort of high level strategic. And so I had the benefit of knowing how private equity investors and board members would like numbers presented and what questions they're going to ask and what sort of bridges they want to see and waterfalls they want to see. And I mean, my FP&A team today still jokes about all the bridge slides I do. Um, but I think it's a helpful way to sort of explain variances, for example, or how do you get from here to there. And then in the years at Bankrate, my role kind of expanded, and so I had a more gradual shift from doing M&A and acquiring companies towards also doing more operational stuff. Uh, and then when I joined Trustpilot, I was sort of already at that point where I had seen like what operations and like running a company looks like from the inside for a number of years.
And if you were to give a little bit of recommendation to the younger generation who are currently associates in private equity firms or any other investment firms, considering potentially transitioning to operator role inside the company, so what would you recommend them maybe to do now, or like what cautions you would give them?
Everything works well on a spreadsheet. But actually running a company is hard in the sense that you have to deal with people and not just a spreadsheet and numbers. And that can be frustrating, and you have to sort of brace yourself for that because even though a strategy may make sense and on paper and it's sort of the model plays out nicely, and when you get to the actual reality of implementing stuff and then having to deal with system issues and limitations and time constraints and budget constraints and uh, really oftentimes it's trade-offs, right? Yeah, we could be doing this makes a lot of sense, but the team is working on that and they got to finish this first before they can get to the next thing. Or sure, this makes a lot of sense, but it actually requires a resource in the tech team, and that tech team is sort of bogged down with something else currently. So the actual day-to-day running, having the right amount of patience and understanding for that, is it's important to sort of like be mindful of that when you go from private equity into that, and the pace is different, right? I think in private equity, oftentimes people are used to working long hours and everybody is sort of at the same pace. And then you work with advisors and they obviously work really hard and all hours. And then if you go into a business with that sort of mindset, and you will come across people that have very different sort of work life allocation and expectations, and rightly so. I mean, they get compensated very differently. And so you have to sort of be mindful of that, and that may be frustrating at times. But it can also be really rewarding when you see something sort of build up over time and you really have the success then.
Great. So I wanted to chat about Trustpilot IPO next. I think that's a very exciting topic. I think we've been somewhat in the dry IPO market for a few years, but finally started seeing some companies are becoming public again. There was a Figma IPO and a few others are planned. 2021, walk me through at that time, so the decision-making process. What were the pros and cons, how you were thinking about together with the rest of the leadership team about that decision to become a public company?
Yeah, we started the process a couple years earlier. We always had the vision we want to take this business public, and so the first step we actually took was in 2018. We we decided to do a pre-IPO round, and you may remember this, but at the time there was a lot of the sort of hot companies coming public, and all these mutual funds all of a sudden also had sort of side pockets for sort of pre-IPO private investments that they were then sort of in the IPO double down on sort of Fidelities and BlackRocks of the world, right? And so our plan was to do exactly that. Find some sort of we wanted to do a Series E led by a public investor that would also do pre-IPO tech investing, and then they would then basically anchor the IPO. Um, and so we went through a investment banking bake-off process in the summer of 2018, and then retained Morgan Stanley to help us with the equity story, and we did a roadshow with them, and then talked to a lot of investors. We were more focused on the UK market at that point in time because our UK business was and is much larger than our US business, even though our US business is growing fast and it's a much larger market opportunity. Um, and then Brexit turmoil happened, and the UK market became very choppy. So the process was tougher than it could have been in a more normalized market environment. I remember having meetings with UK public investors, and they were saying, you know what, sounds really interesting, great company, but my quarter just went to hell. UK equity markets had gone down quite substantially, and so we ended up finding a fantastic investor in Advent through their public vehicle. And they've been a great backer of the company ever since. But that was sort of the first step where we really worked hard with Morgan Stanley in crafting the equity story and thinking ahead, sort of how we're going to take this forward. Then 2019 rolls around, and we said we were going to, like, our ambition was to then sort of aim for an IPO in 2020. And so in 2019, we did a non-deal roadshow with Morgan Stanley. Um, and that was helpful in the sense that we had met people in 2018 who couldn't invest at the time, but who had started to follow the company. In 2019, we didn't have anything to sell. So it was really just like, hey, let us give you an update. Here's what we told you last year, what we're going to do. Here's how we did. And so we started building credibility as a management team around execution, helping people understand the story even better, getting to meet additional public investors. This was sort of then with the idea of eventually we're going to come to market. So you want to start following us and you want to start understanding the story. And then in early 2020, I still remember this, we had a discussion with the board and they were like, okay, there's an open window. You got to go now. And I had spent a little bit of my personal capital trying to convince people the company might need another 6 months or so. But the board decision was, no, we're going to go now. And a week later, the world shut down. And so things got put on pause. It was a really interesting time to run a company because we went obviously from being in the office to fully remote. All of a sudden, everybody stopped buying new software, and we had to look at sort of downside cases, thinking, well, what are we going to do if actually this continues and our new business is going away and our retention drops dramatically? How do we contingency plan? We took some costs out of the business. We became profitable, and then kind of the world obviously fairly quickly reopened, or certainly the markets recovered in the sense that we were able to like grow the business again. And so we kind of kicked off the process in earnest in September, but it was all virtual. Um, and so I was based in the US at the time. Our founder was in Denmark, and we we did a non-deal roadshow that was sort of like a pilot fishing exercise in the fall of 2020. And at the time, I could travel to Europe, and he could travel, and so we met in Switzerland because Switzerland had no quarantine requirements, and so we met in Switzerland in Zurich, had an Airbnb, and did our calls together because it was like healthier to do these meetings together in person, even though they were all Zoom meetings. So but in between meetings, we could go outside, take a walk along the lake, and talk about the meeting and how we're going to sort of present something else, or present something going forward, and really sort of improve the presentation over time. And it was another sort of set of meetings with similar people we'd met before, and then also new investors. And then the next set of meetings was in early 2021, where he came to the US and we did them out of our New York office, even though it was still, I mean, Europe at that time was shut down. The US wasn't as much, and he was able to come over and we were doing the meetings from New York, but it was very cold. And so for the second week of meetings, we decided we're going to fly down to Miami and do them from a hotel in Miami, which was much nicer. And then the actual road show was again virtual because the UK was still shut down, and I think we did it out of Madrid because at that time Madrid happened to be the place we both could fly to without quarantine and have the meetings. Um, but at that point in time, the once we opened the book, and was like immediately filled because a lot of the investors had seen us 3-4 times since 2018, some of them. And so we laid the groundwork very strategic a number of years ago.
Yeah. Wow. Yeah. What a story. So many years of preparation for that, and then I'm glad that eventually timing worked really nicely. If you could redo the IPO today, would you still list in London over Nasdaq?
Yeah, at that point in time, and for the size of the company, and I think if you look at our market cap today and at the IPO and our size of the company, we would not have had the coverage. Also, as a US, to actually have any US index inclusion, you need to be like a US business. Otherwise, you need to have a larger um, market cap, etc. So I think it was for the size of company we were and where our main investor focus were and the brand awareness we had in the UK, it was definitely the right decision.
Yeah. So just before this, I know we were discussing about the life of public CFO. What's one hard truth about IPOs that private CFOs don't understand?
I think I mean, your board will change, your day-to-day focus changes, more outward focus towards investors rather than inwards focus of just growing the business. What actually happens is, I mean, it happened to me. Happens more frequently than you know, especially if you've been there for a while. Kind of you work towards this IPO goal for many years, um, and you get to the finish line. You IPO the business, and then you almost fall like in a bit of a hole where you're like, okay, now what? Like I've worked so hard to get to this point. You're there. You're public, and then you have to go through that transition. You will see quite a bit of turnover in employees because a lot of employees have just waited for that moment of liquidity. And so in the year subsequent to the IPO, we've seen quite a bit of people just leaving because they'd been there for a long time and they felt like, okay, now's the time to actually do something else. I've reached that goal. And you have to kind of find yourself again as a management team, as a company, to identify sort of that next milestone. What are you working towards next? Because at the end of the day, an IPO is just another fundraising event, and then you have different reporting requirements going forward. You have probably frequent board meetings. The compensation schemes for employees change from options to RSUs or LTIPs. performance shares, and those kind of things. Um, yeah, and as a CFO, you definitely spent more time going to conferences, meeting with investors, not the once a year roadshow. It's like three, four, 5 times a year, and then the meetings in between and the calls in between.
Yeah, no, it's incredible how sometimes, especially in the early stage companies, IPO is that sort of like a target where like everyone is marching towards, but when it happens, then what? It's just sort of one of the events in the company. Definitely, sort of not the reason why the company exists. Many companies exist, and yeah, transition through that period is definitely interesting. Hanno, wanted to next chat about capital structure. I think throughout the lifetime of Trustpilot, you use different mechanisms to fund the company. 2017, you used debt, 20 million SVB debt, and then after that, you did equity funding as well. So usually, for software businesses, it's not typical to use debt financing as well. What convinced you that was the right move in 2017? Just curious, like what was your thinking process there?
So this was a venture debt facility, and I think we used it to basically minimize dilution at the time and extend our runway before we did our Series E financing. I don't think we tapped into it significantly. I know we restructured the facility in 2019 after we did the Series E and had more cash to be more of like a revolving credit facility, just to have sort of additional liquidity buffer. And that actually we then drew on in 2020 during COVID, which I think most people did that. Everybody said, "Hey, I have a revolver. I'm going to draw my revolver and put the cash on the balance sheet," because um, March 2020, April 2020, if you recall, was sort of a really uncertain time, and people weren't sure, if I don't draw it now, I don't know if I can be drawing it in 3 weeks if things get worse. And so everybody drew their revolvers. But in 2017, when we did the venture debt, it was really sort of to extend the runway and to limit dilution somewhat, and then have the chance to grow the business further and then raise money at a higher valuation. But it was never meant as sort of I think you don't want to do that if you're not profitable. And even today, I mean, I think we're rapidly expanding our EBITDA margins. We're becoming a lot more profitable. But I mean, if you think at sort of normal leverage ratios, the debt capacity of the business is growing steadily, but it's still more limited, and we're quite happy with our current sort of balance sheet structure with some cash on the balance sheet. Um, as the business becomes more profitable over the years, I think our minimum cash requirement will go down, and there's certainly a path where, as the business matures, and in a number of years, you would think of a net debt position where you say, okay, now there's so much profitability in the business, because inherently software businesses can become very like high margin businesses, right? And so Trustpilot will be as well. And at that point, there's no reason to have an all equity financing structure. Then you get into the tax efficiency of debt and the interest tax shield, etc. Currently, we're in a sort of net cash position, and then we're returning excess cash to shareholders through a buyback.
Clear. Uh, if you had to boil down debt versus equity framework for the founders, in a simple framework, what would that be? How should founders think about the debt versus equity?
Well, I think with equity, you know your dilution, but you know you're not going to lose the company necessarily. With debt, if things go sideways, especially for a loss making startup, debt can be very difficult to service, and then they typically have maturities, and I think that's kind of probably almost the bigger problem, right? You always have that sort of looming maturity of the debt, and then you have to either refinance it, um or you have a real problem. When you raise equity, there's not necessarily a maturity, and there's not a sort of ticking time bomb there. And so I think you need to have a pretty good established business with a path to profitability. I mean, the way we thought about fundraising, there was always this sort of 3-year plan to profitability, that the money you raise gets you to profitability. And then you can sort of a couple years into the plan, you can decide actually we're making really good progress. We're going to invest more for higher growth, and we're going to raise more money because we're going to be able to raise more money on the back of the performance that we've shown to date. But the moment and there were moments in like 17, 18, where all of a sudden venture capital dried up for a while and people said, oh, we're going to all switch to profitability now. And you then have to adjust quickly, and you have to be able to adjust quickly and not just kind of keep burning cash. Like there's always going to be another fundraising because there may not be. And those periods are rare, but they do happen, right? Um, and so I would say I think the way we did it with the debt in 2017 was very sort of thoughtful and not just as a now we're going to spend it all and hope we can raise more debt, but rather sort of as a bridge to a financing. And like I said, I don't think we really tapped into the liquidity anyways. It just expanded the balance sheet at the time.
Yeah, that's clear. Um, So changing the gears a little bit towards the efficiency profitability, as you mentioned that now. So this is obviously now becoming an important topic for many companies, not as it was a few years back. So the journey for you was from losses to I think looking at the last reports, 11.4% of adjusted EBITDA margin. So I assume that was a pretty tough journey to get there. Can you walk us through sort of like what are the steps you've done? So what was the actual process getting there?
Well, actually, it's not that tough in a software business. You just have to be very mindful about incremental investments. Because if you think about it growing, and this is sort of the beautiful thing about software, right? If you have a growing software business, you acquire new customers and you spend sales marketing expense, but that's sort of a one-off expense. And then you have this recurring revenue stream that hopefully drops through at pretty high gross margin. And our gross margin, including the cost to retain customers, upsell them, and to service them, et cetera, is over 80%. And so and then we have high retention rates. And so you basically, once you've acquired the customer once, you get this sort of perpetuity revenue stream dropping through at 80% margin. And so inherently the existing business is highly profitable, and you invest into sales and marketing expense to acquire new business, and that's almost by definition a loss-making endeavor because you spend sales and marketing expense today. You, for example, spend commission. You have bookings, but the revenue then follows in the subsequent 12 months. But as the business grows and the retention base becomes larger and larger, you have sort of this inherent trend towards profitability. And then obviously you have G&A and tech and product, and you want to keep investing into product and innovation to be able to continue to upsell your existing customer base, and you got to find the right balance there. Um, and for us, for Trustpilot in particular, every market goes through this sort of J curve, um, where we need to build network effects. But fundamentally, software businesses should become profitable over time. And we saw this in 2020 when it was more painful because we took some cost out. But in sort of post IPO, we had invested more into growth again, because in 2021, every investor was like, you just raised a lot of money, you should invest for growth. And we came back to the market in 2022 and said, good news, we've heard you, we're investing more for growth. And the investors said, what are you talking about? We're now all on the profitability. And so it took us 6 months to catch up, and then we were profitable again. Because we just sort of slowed down hiring, and the business continued to grow. And the moment you do that, sort of the margins continue, it starts to drop through.
Why do you think? So it seems like the formula is pretty straightforward. Why do you think still a lot of companies are not disciplined enough and they're still loss making for a longer period of time? They should probably then they should.
Well, it is straightforward, but it's not easy in the sense that you will always have competing priorities within the business. And I mean, our budget discussions now are much harder because you actually say, well, we're going to improve profitability. And so there's only so much money we can invest. And there's a lot of great ideas that could be funded. And so if you're private and you have a conversation with your board and you tell them, oh, here's all the great things we can do, and this is going to be a much larger business, and we're going to be um, accelerate growth, there's probably a tendency to not be ruthlessly efficient and prioritize and say, okay, this is nice, but we're not going to do this, because everybody, especially in venture-backed scenarios, people tend to swing for the fences, right? And you'd rather make that marginal investment and see what it pays off. While we're now public and we have to be very sort of disciplined, and we can't just sort of make some investments, see if they pay off. You have to be very prudent with your capital, and we have to deliver sort of that incremental profitability. And so that leads then to trade-offs, and like, who's getting the headcount? Like, are we hiring this head or that head? When are we hiring the head? Do we wait another 6 months? And scarcity breeds innovation, and I think it makes the business more efficient. But you all have to have those tough conversations within the business and with the management team, um, because everybody comes. I mean, I assume good intent, right? Everybody comes forward with ideas of like, "Hey, this would really help my team. This would make them would make their lives a lot easier. They're really stretched." And that's probably true. And then you have to find out who's stretched the most, and where do you give, and where do you keep the tighter rein. And it's much easier to just say, yes, we'll fund it all, and it's going to be a growth. It's going to be a huge business at some point in time. We're making some losses. It's easier to do that than to run a like a an efficient business.
This is great. One full up here. So it all goes down to those tough trade-offs that a leadership team needs to make. But then the role of CFO is incredibly important here, and a lot of these trade-offs, they are really deep into the context of the business, into the context of the operations. Curious, sort of, when you think about the role of the CFO, how deep you should be actually in those details, and yeah, or it's just sort of like collaborating with the right people in the team. So a little bit question about the role of CFO.
I mean, I think you need to understand the business, right? And you really need to understand the levers you can pull and what happens if you invest here. Um, Sometimes there are investments that you know you need to make that are not going to have a immediate payout. There's obviously gray areas. I mean, the sort of if you think about marketing spend, for example, right? You can start at like, we do paid marketing. We're going to buy traffic. Traffic converts into leads and demos into deals, and that's a pretty clean way of measuring an investment. Then you have investments into product. Hey, we're going to sort of build this new feature. We're going to release it next year. It's going to lead to this much upsell. And you kind of understand why you would make that investment. And then you have other investments into systems and tooling or PR. They're a lot more unclear on the benefit, and where you need to have a sort of an understanding among the management team. Like, yes, we can't measure the return as cleanly, but we all look each other in the eyes and say, this it's the right strategy. It supports the strategy, or it sort of fixes a foundation. Right now, we're talking a lot about making investments into processes and optimizing processes to be able then further down the line automate these processes, right? But that requires, at the end of the day, it's work, and work requires people, and people need to be paid. So it's another sort of investment there you need to make, where either you have existing people that do that work instead of something else, or you need to bring in additional people to do that work. In either way, it costs money and it needs to get done. And I mean, Trustpilot's been around for a while now, and so there's a lot of processes and a lot of legacy in the business that needs to be unpicked and fixed in some areas, while maintaining growth, investing for growth, building new product. And so you have this sort of, on the one hand, it's that example of a swan that's like, from the outside, it's like gliding across the lake beautifully, and underneath it, there's a lot of paddling going on, and a lot of people doing a lot of work to make it happen, look smooth and up and to the right.
One question, just imagine it's not about Trustpilot because the margins in Trustpilot already gone through the optimization phase. If you were a CFO of a new software company
Yeah.
in the first days, and if I gave you one quarter to find 200 basis points of margin, where would you look first?
Where would I look first? I mean, I would probably look at slowing down hiring first, um, and then understanding like where do we really need to add roles, or where can we be more efficient with the existing roles? Because the tendency tends to be you just add more people, and oh, we have this thing. Let's just like we want to do this thing. Let's just hire someone else. I mean, at Trustpilot, we became a lot more focused on G&A initially because it makes sense. You don't want to have G&A balloon. You want to have sales. I would invest into sales and marketing first, tech and product, and then in G&A. And depending on the company, if it's sort of product-led growth company, you'd probably invest in the product before you invest into sales and marketing. Um, and so you need to be really vigilant there. I would try to see if there's ways to automate processes that enable you to free up resource internally so that people can be more productive doing other things that are more value added than um, manual processes. And that would give you probably also improvement. But honestly, by just stopping hiring for 2 quarters, you'd probably be finding a lot of margin very quickly if you had to.
It's actually interesting. It's also um, scarcity of resources drives the right conversation in other teams as well. Like, why we're doing that? So, is that the most impactful product we would like to build, etc.?
Yeah. Yeah. Because if the product team has unlimited resources, they can build anything. But if you tell them you can only build these things and they need to basically you need to stack rank them and you really force them to rank them, or you basically say, ask the sales team what they think they can sell the most of and then build that. Um, at the end of the day, it needs to be a cross-functional effort. It cannot be someone sitting in the basement saying, I want to build this product, and then sort of chucking it over to the sales team and say, hey, sell this. And the sales team is like, oh, we never asked for this. No one's asked for this. Have you done the market research? But at the same time, you can't just have the sales team sort of determine the ideas. Some enterprise customer comes to the sales team like, yeah, can you have this feature and functionality? And this cannot be the way you drive your product roadmap either, right? It has to be sort of more thoughtful around doing research, understanding where's the market potential, what's the total, like, is it just one customer who'd love that? Or is there actually something that's scalable that you can sell to many customers? And then you want to build it.
I'd like to discuss the life after IPO next. So you already mentioned a little bit, a few things on that topic, but what part of the job actually got harder after IPO?
Well, I think everything is higher stakes to some degree, right? Um, you have public filings. They need to be 100% accurate. You sign your name to it. Um, you want to make sure that you have the right controls in place. Um, you have your quarterly numbers or your semi-annual numbers. You set a guidance to the market, and if you miss the guidance, the punishment is severe and immediate. If you meet and exceed guidance, you may get rewarded, but you may also not get rewarded depending on the market environment. But you know for sure if you miss guidance, it's going to be brutal, and you have to constantly sort of think almost 2 years ahead in terms of like if we overachieve here now, people are going to take their numbers up 2 years out, and then next year you sit there and you have to deal with that issue. So you need to be forward looking, um, and sort of communicating with the market and managing expectations, um, and then delivering on the business. I think it's just like a very, I want to say it's a higher amount of rigor and discipline required than if you have a handful of investors who are, they just try to build a large company, and there's maybe less sort of attention to detail in some degree, as long as things are generally progressing in the right way. Um, because the market gives you this more instant feedback around, well, you missed here, so bam, we're going to take your market cap down 20%. While you're private, no one gives you that immediate feedback, and so it feels less impactful maybe, even though if there was a true mark to market, that would probably also happen.
Does it worth it then if you can get access to to the same valuation in a private market and the same capital, same capital in terms of the size. I mean,
It's a really interesting question because ultimately there's liquidity concerns for old investors. There's liquidity and the ability to attract and retain talent through public equity that you don't have when you're private, right? I mean, we were private for a very long time. Eventually, like we'd given people options, employees options, everybody participated. But if this is sort of far out and you never actually can exercise, then eventually people will lose interest in it. And you have investors eventually who need liquidity. I mean, that's the nature of venture capital and private equity is they invest other people's money and they need to show returns that are not just on paper, but actually cash on cash. And so having access to liquidity is worth a lot. And once you're, I mean, the one other great thing is like once you're a public company that is profitable, you're basically masters of your own destiny. I don't have to go back to hope that I can raise another Series F or whatever. In a growing software business, in theory, you'll never have to raise another round, right?
Yeah, so the next topic I'm super excited about is future of finance and impact of the AI to finance as well. So in our private conversations, we had a little bit of chat on this topic before. So very curious to hear your thoughts. How do you think in the next 10 years a finance function will evolve, especially with the such a significant technology that is available for all of us today?
I just did a sort of a finance summit with my entire team, and we thought about sort of where we are going to be in 3 years and what's the vision for our function. And there was a lot. We spoke a lot about AI and moving away from just reporting the numbers towards like analyzing and um, shaping the business and giving good advice. And obviously, we do this in some areas and have always done it. I mean, the FP&A team, commercial finance teams, obviously do nothing else but I think technology and automation is a huge opportunity for finance functions to be a lot more value add than they are currently and a lot more efficient than they're currently and to have a lot more meaningful work for the people in the function. So we did actually a little sort of AI hackathon and try to find some quick wins where we could automate things through AI and did some proof of concepts for some of those. And it's amazing when you actually put your mind to it and everybody sort of embraces AI as that sort of tool that helps you automate manual repetitive processes. Everybody sees the potential. And so I think it'll start with good processes. So we certainly in our end have some work to do to look at processes that have been there forever and say, actually, do we still need this process? Is this the right way to do the process? Because you don't want to automate a bad process because you just end up with a bad automated process. You want to have good process design and then automate as much as possible. And to do that, you need tools and systems that speak to each other. So we have an ERP system that doesn't play nice with a lot of other systems. There's not like well-defined APIs. That's not long-term sustainable in this new world where you actually want to have systems just talking to each other and automate the processes between those systems, right? And so that's going to be a lift. And then you have that then though frees up a lot of resource for people to do other things, more value-added things. And I mean, I'd rather have someone who's not copying and pasting information from one system to the next, and then into another system which is prone to errors, etc., and automate all that. And so, if you could build a new finance function from the ground up, I think you want to be very mindful around the tech stack you build and make it future-proof, and the processes you implement and make those as automated as possible. And then you need fewer people to do that. And the people that work for you will do very meaningful work because all the manual tasks have been automated.
What are the workflows you think will be gone to AI first?
Probably a lot on the AP side, and also on the procurement side, because a lot of that is sort of just filling out forms and understanding requirements and then matching transactions, etc. And then probably sort of on the reporting side, aggregating numbers, consolidating numbers, maybe even getting to a point where if you have a good enough tool that understands all the transactions and budget and that can do variance analysis on a transaction level and then spit out a report to that level, I think that's also something that can be automated.
Speaking a lot with the different finance leaders on this topic, and with the people who are actually also doing the work on the ground as well. And I think sort of like you also see a little bit of concern from mid to junior members of the finance teams on sort of like, okay, like automation counts, what I'm going to do if my work is automated. How do you think, like, what are the best practices to enable and help those people to embrace this change and maybe go through this transition so that they indeed can actually transition to the world where they can do different work and more value added, more strategic work for the business.
Yeah, I don't think there's a shortage of stuff to do. But there's obviously certain things that have to get done. Um, and so you always need to report your numbers. And so in order to report your numbers, you need to create the numbers, aggregate it, all that sort of stuff. I mean, we just had that discussion with the team, and I think everybody came away very optimistic and enthusiastic about the potential because at the end of the day, everybody has stuff on their plate that is repetitive, manual, not particularly exciting and fun, and just has to get done. And if you take that away, like I said, there's always ad hoc requests and other stuff that we need to and could do. And the business continues to grow. And so if you tell people, hey, you're not going to get more headcount, you got to do that. All we're doing today, but at twice the scale, because the business is going to double in a number of years, they feel overwhelmed. But if you tell them, hey, we're going to double the size of the business, but we're going to take all the manual work away, that is obviously a lot more palatable. Now, if to be candid, if I was in a slow or declining business, I think people might feel differently about this. But they will probably also and already feel a lot of sort of pressure around cost cutting, and they will probably have a lot more on their plate than they can handle. And again, you take stuff off their plate, and it makes their life a lot easier. So I don't know. I'm a real optimist, and in terms of the potential for AI and what it can do, and also in the finance function.
How do you think the role of CFO will change all the time as well?
Well, I think you get more access to data more easily. And so it's going to be more self-service almost in the sense that rather than emailing or slacking or whatever, reaching out uh, to a member of your team with a question around data, there will be a chat bot that you can ask those questions preliminary, and they'll give you a pretty decent answer to begin with because the chat bot has been trained on the underlying performance data and transaction data. And like you can ask like how is bookings growth months to date in region X, and you don't have to navigate through Salesforce dashboards and update them and make sure you have the right Salesforce dashboard, etc. But you just ask the chat interface and it'll pull the numbers for you, and but then again, it's about like having the proper definitions, data governance, all that sort of stuff. All that needs to be in place before you can do this reliably. Otherwise you're going to get, I mean, garbage in, garbage out, right?
100%. Yeah. So that's something that we're consistently seeing as well. Is just opportunities there. There's like so much um, efficiency can be brought, but at the same time, just to get to that point, the foundation needs to be built, and that's why I think compared to some of the other um, orgs, it comes to finance a little bit slower than legal or other orgs, but it's surely sort of like coming there and will give massive efficiency for the teams. Maybe a few quick fire questions to wrap our chat. Um, what's a career decision you're proud of that others thought that was reckless at the time?
Oh, so I went to University of Bonn and I got my, at the time was still called a diploma in economics. And as part of that, I spent a year abroad in Canada and went to the University of Victoria on Vancouver Island. And I was able to take courses in their master's program. At that point in my life, I'd never thought, oh, well, I go abroad to do a master's. I sort of pretty much set on coming back, start my career, start working at PricewaterhouseCoopers, PwC. Um, but having been in Canada opened sort of my eye to the idea, well, I could actually go back to school, even though I have a diploma, which was sort of master's equivalent in the German academic world, and do a master's in finance. And so I applied for a master's in finance and quit my job at PwC. And people were like, well, you could just like put it on hold. You're crazy. You just have like this contract that is sort of infinite. Basically, there's no term to it. You have your career here now. And I said, no, I'm just going to do this and see where I end up afterwards. And had actually sort of made up my mind. I wanted to go into private equity afterwards, and use it as a stepping stone. And I'm no regrets. Obviously, it all worked out and played out, hoping it would. Um, but at the time, people were like, you can't just quit your job to go back to university.
What finance skill will matter most in 2030?
But finance skill, you need to be able. I think it still matters that you need to look at a set of numbers and see what's the wrong number, because you have a sense for, like, you just have an understanding of the business, and inherently, I don't know, I think that's my secret weapon. And my team sends me a set of numbers and I said that number's wrong, and they're like, let me take a look. Oh yeah, you're actually right. I think having that will always be important and it's always helpful.
When I was just starting my career as investment banking research analyst, I received this advice in the first week when my manager found some mistake in my model. Basically, said it's not just numbers. There's a business behind that. It's all about intuition and it's all about what's behind the numbers. Yeah.
Right. Yeah.
Yeah, yeah, this is a fantastic one. And then the last one, what's the one book, podcast, or blog every CFO should know about or read, or like what's your favorite?
I don't know. I think people need to like, if I think back to the university courses, so the sort of just general understanding of valuation, finance, how financing and the capital structure should be irrelevant to evaluation of a firm, like those kind of fundamentals. I think these are really important for a CFO to understand, like basically corporate finance. Sort of, I'm sure there's great books on corporate finance, and but those were the courses I liked the most in university, and I still think those are really interesting to really understand, fully grasp the concepts behind it.
Yeah, same here. That was like my favorite courses during my MBA studies as well. Thank you so much, Hanno. Really appreciate for this conversation. Also, fantastic learnings to share with the larger community here. Yeah, really appreciate for the time and really enjoyed this chat.
Yeah, likewise, it was fun. Thank you.